Car trouble for the economy, how the lending slowdown has seen vehicle sales hit a red light.
Wait, what? Lending slowdown? Hit the red light? This is the first I hear of it. In any case, it's not being advertised out there because they've just cut the interest rates to the historic record low of 1.25%, which is and was supposed to encourage lending. It isn't yet. The unemployment steady, meaning low, again historically. So what is the problem at the moment? Why is the Reserve Bank panicking pretty much and sharply cutting interest rates? What are they not telling us? It is like, hey, everything's okay, nothing to worry about, but we're just going to cut them again and again and to ever so historically low levels. And before we continue on, I just want to make a quick note on one of my videos, just recent video, where I talked about auction results. And these are the auction results of last Saturday, 22nd of June. And today's also Saturday, 29th of June. So 7 days ago, clearance rates, say in Sydney, according to Domain, domain.com.au, in Sydney was 63, Melbourne 69, Adelaide 56, and Brisbane 21, and we got Canberra 61%. Now, there were some comments by viewers, very good comments arguing the point that these clearance rates are inflated. I tend to agree, but so why do I report them? Because my philosophy on this is that if they are inflated now or last week, 22nd of June, they would have inflated the week before, and then the week before, and then a month before, and then 2 and 3 months before, and 6 months, and 2 years, and 3 and 5 years ago. So if we on average think that they inflated by 10, 20%, we can make this 50%. But if it was inflated now, it would have been inflated before. So we have to compare apples to apples. So we have to take these numbers as the figures, and if we assume again that they have been manipulated, they have always been manipulated. So we have to stick to these numbers. The only further note is also valid is that if the clearance rates were, say, 70 or 80% in the best of times, they didn't have to manipulate them, where now maybe they truly are 40%, so they have to be manipulated so they don't cause panic. That is possible, but it's very hard to know unless you dig into the numbers, which I'm really not going to do. On this channel I talk about, let's call it a gist of things and the numbers, and more of a psychology of buyers, first home buyers, investors, as opposed to the pure real empirical numbers, which are of course important because that's where everything starts. And if you need something like that, I mentioned it in my video, the channels that I follow is Digital Finance Analytics by Martin North, where he thoroughly examines all the numbers, and he's got his scenarios as to the percentage of what scenario, depending on how things change. He updates those as to what can happen to the economy, including where the banks are going or likely to go, where the interest rates are likely to go, geopolitical, and then what does that mean in terms of prices of houses. Now back to the whole credit thing and a Reserve Bank cutting interest rates so sharply as if they're panicking and know something we don't. Most cars are bought on finance. When you look around and see all these European cars being driven around, and they cost anywhere from 50, 60, 100 plus $1,000, you think to yourself, who would pay $100,000 for a car? Well, they didn't. They got finance. And that was my experience, which I shared in one of my videos a long time ago, where I was looking to buy a car and trying to get a really good deal on a car that's maybe 1 or 2 or 3 years old, and the car dealers were bluntly telling me that they'd rather do a much better deal and give me a better price if I also got finance from them, because they make more money on the finance than the car, which is sad state of affairs, to be honest, where I had the cash and I said, look, I'll pay you cash. And they said, we don't want your cash. We want you to sign the dotted line and get a finance.
Car sales have been dubbed the Camry in the coal mine for the economy, and the latest numbers show cars and the economy stuck in the slow lane. New vehicle sales slumped 7% in the past year, the worst performance since just after the GFC. It comes as uncertainty triggered by the Trump trade war drives demand on the global car market down to a two-decade low. Stephanie Chalmers has the story.
This major road in Sydney is busy, but for car dealers along the strip, it's been anything but.
In general, it's quiet. It's very, very quiet.
Sales for new cars in Australia have fallen for 14 consecutive months. That would normally mean an increase in sales for used car dealer Robert Barkos, but this time not so.
We've got a workshop at the back and we subcontracted out to a detailer, and he's generally very, very busy because he services most of the dealers around the local area. But the last couple of weeks he's been very, very quiet.
You've got the election, you've had a negative impact on lending as a result of the Royal Commission, and you've got what I call the negative wealth effect of people's houses being valued at lower prices.
It's a cocktail of conditions that's dampened consumer confidence and household spending, and car sales in particular are linked to the housing market. CommSec tracks sales of 17 high-end brands, from Audi to Mercedes-Benz, against home prices, and as one heads south, so does the other. It's a link that didn't go unnoticed by the Reserve Bank in the lead-up to its first interest rate cut in nearly 3 years.
The wealth effect is highest for spending on motor vehicles and on household furnishings,
giving weight to the argument that the canary in Australia's economic coal mine is actually a Camry.
It's something that's eminently postponable. So if there's grey clouds on the horizon, people can easily make the decision, I'll run that car lease another 6 months or another year, I won't turn over my ute.
More than 1.1 million new vehicles were sold in Australia during the past 12 months. That's down 7% on the previous period and marks the biggest annual decline in over 9 years. But it's not just Australian buyers hitting the brakes. Global sales are expected to fall by 4 million this year.
They're able, once they've bought the home, to start chipping away at those renovations. And then we look over into the driveway and we see a brand new Mercedes.
Marketing specialist Georgie Brooks says using data is key to boosting sales.
We've seen a lot of real estate companies come through and really embrace data. And what's happening is they're evolving and they're leaving their competitors to wither. The automotive industry needs to do this.
Mr Brook has compiled information from around 5 million recent car sales and demographic data and says would-be buyers may not be who you think.
Large luxury SUVs are being purchased brand new off the forecourt by affluent younger families. It's the pre-retirees that are waiting 3-4 years for those younger affluent families to sell their vehicle, and they're snapping them up in the second-hand car market.
Economic conditions aren't the only potential speed bump for new car sales. Car sharing is a small but growing part of the Australian market and can be a viable alternative for inner-city drivers. When software consultant Anne-Marie Priestley moved back to Australia from the UK, it was a temporary fix that became more permanent. So Anne-Marie, how long have you been car sharing for?
We've been car sharing for 5 years now.
And before that you were always car owners?
Yes, I've had a car since I was 17.
But for Anne-Marie's sons, who are slightly older than that now, they're learning to drive in shared vehicles, and the future could be carless.
It's not only the cost, and that definitely is a factor for the younger generation, but I think the environmental benefits as well play a factor with them.
While a significant threat from car sharing might seem a way down the road for dealers, they continue to grapple with current conditions. Car sales figures released next week will show whether the RBA's rate cut has helped slow or stop the decline.
The economy may be spluttering along, but the Reserve Bank Governor says it's unlikely we will face another financial crisis. Dr Philip Lowe says there are limits to what central banks and rate cuts can do to boost the economy. Speaking in Canberra, Dr Lowe has again called on government to do more of the heavy lifting.
Okay, so it's unlikely we're going to see an economic crisis anytime soon, yet they're really, again, sharply cutting interest rates. And what they're saying now, if the private sector, if you and me, mums and dads, don't want to take up more credit, they are saying, well, the government need to do more heavy lifting by borrowing on our behalf and spending into infrastructure, which is one of those things that everyone thinks, yes, we need infrastructure, but a lot of it is mismanaged, and it's a lot of money being invested in it and not always best spent. So getting into debt, getting the government into debt, meaning getting us into debt via the government borrowing, is also, in my opinion, not a smart move. And once again, not a financial advice, and why would you take it from someone like me? I would not and will not, get a loan. If you really need to take $500,000, $800,000, $1 million or more to get yourself a roof over your head, or to, for some reason, want to invest in property, I wouldn't. It's just too much. Way too much. What I say is that, leave it to the next fool or gambler who is obviously having a more positive outlook on the property and is maybe looking long term, which also doesn't guarantee you any positive results when it comes to any asset class. So what do you do until such time you are able to buy a house by borrowing less than $500,000, for example? Is that sit tight, wait until it becomes more affordable, more sustainable, and not insane like it is now. So who's saying they're going to cut interest rates sharply? Well, market watchers. Listen to what market says, what market watchers say, professionals who are in the business of looking at these things, unlike me with a day job. So have a look. The best for last, as always.
The Reserve Bank Governor Philip Lowe has been speaking today, driving home the same message. The market's now factored in a July rate cut.
Yeah, it's not just the July rate cut. It's actually surprised a few people. Westpac upgraded in terms of moving their rate cut expectation from August to July. The market has an 82% probability that rates will come down by another 25 basis points next Tuesday. It's a certainty by August. But what is really interesting is that by August, it could actually be 50 basis points out. So not just one next week, one again in August. That would be 3 consecutive rate cuts in a row. And the probability of that is now sitting at around about 72%. And that is amazing, considering that 3.5 months ago, one rate cut was possible by August, with another one maybe by November. We are now staring down the barrel of a 72% chance of 3 rate cuts in 3 months. Very, very sharp and shiny. It is also now becoming political. You can see that clearly with what Labor has brought forward today as well, with about bringing forward stage 2 rate cuts to tax. We really need to stimulate our economy fast, and that's what the market thinks. It's clearly what the RBA thinks as well.
Evan Lucas.